This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Separate legal personality. Salomon and Salomon, the grandfather of company law cases. These are the distinctions with the advantages of being a company as distinct from being a partnership. It's a past exam question. This is a past exam question. What are the advantages of incorporating your business or running your business through the means of a limited company as distinct through being a partnership or a sole trader? Limited liability is the second one, and of course that's self-explanatory, that the liability of the people who are invested within the company have a limitation to the amount of their liability. And the extent of their liability is limited by the number of shares they hold or by the amount of guarantee that they have said they will pay in the event of a liquidation. So limited liability. A partnership, limited liability, well, there are things called limited liability partnerships, and there's also an animal called a limited partnership. So there's two separate animals there. One was thought of and put into statute by the Limited Partnerships Act of 1907, but a relatively recent one is the Limited Liability Partnership Act of the year 2000. And that does afford partners, some not all, of the partners in a partnership, it does give them the opportunity of limiting the extent of their liability. But in both of those situations, both as a limited partnership and as a limited liability partnership, there has to be someone who carries unlimited liability. So the fact that you're a shareholder or a member of a company means that you are protected. Your wealth, your personal wealth, is protected. Now, having said that, it is potentially the case that even if you're a member of a company, you may find that your personal liability is not limited. There are situations where the court will say, yeah, we are going to impose a liability on you. Even though you are a shareholder with limited liability, the court may direct that because of your past actions, you should be, your liability should be extended because you've been naughty in the past. All right? But we'll come to those. We'll come to these exceptions later on. In fact, we can see them, I think, on page 65. So limited liability is a certain definitive, clear, certain advantage of being a member of a company as distinct from being a member of a firm. Perpetual existence, no matter what you may want, and medical science aside, no matter what you may think, at the moment medical science does not allow us to even think about perpetual existence. So perpetual means everlasting. Perpetual, everlasting. So we, because we're human, are of a finite existence, that we will die. It may be that before you die, it may be that medical science has found a way of keeping you alive. I don't see that this will happen in my lifetime. But it may be that, do you want to stay alive forever? Do you? And become old and wrinkled and slow? Do you want to finish up like John? Is that what you want? So a company exists until it is killed. You can kill a company. It is available to wipe out a company and liquidate it. But a partnership, the three of us were in partnership earlier. When I die, that partnership finishes. That's gone. And these two then set up again a new partnership and maybe invite Leanna to join the partnership. But it's a new partnership. Whereas with a company, if a director or a shareholder dies, the company still survives. It still exists. And in an extreme situation, if all the shareholders are killed, If all the directors and the auditor and the company secretary and the company's banker and the company's financial advisors and all the employees are all wiped out in some nuclear disaster, the company will still rise up out of the ashes. The company will still live. So there is an advantage to carrying on your business as a company. The company will live. If we carry on the business as a partnership, the partnership stops on the death of a partner. Well, yeah, if I get killed in some nuclear, and we all of us get killed, and all the employees and the directors in partnership, no, you can't inherit a partnership. No, you can't. You can't say to Eddie and me, listen, I'm a little bit tired of this work, I don't like all this work, but here is my son, let me introduce him as a partner. I mean, your son is probably a very nice person, but my son is, deep down, he's a very nice person, but maybe you wouldn't want to meet him. Maybe you're not used to the idea of a green spiky hair and metal hanging off bits of his body, and maybe you don't like people with bolts through their cheeks. Maybe. You do? All right, well, here's my son, he's your partner. No, you can't introduce someone, you can't inherit a partnership. You could in the family situation that me and my wife here and our son and me and wife are in partnership and we can bring our son in, but it's not inheritance. It's just inviting a new partner in. So, no, you can't inherit partnership. You can inherit shareholding. If I have shares, if I've got shares in a company and I choose to leave them to my daughter Sandra, I said I leave my shares to daughter Sandra. I can give my shares to daughter Sandra whilst I'm alive. I can just transfer them to her. And the company can do nothing about that. But I can't say, I don't want to work anymore. Here's Sandra, she's your new partner. I can't do that.
But here a member of partnership can be a limited company.
A member of a partnership can be a limited company, yes. You can have more than one partner who is a limited company. That is available. But you're a member of a limited company, and it's the limited company who is the partner. In order that that limited company should be able to talk at partnership meetings, you don't see many limited companies walking down Squallish, do you? There aren't. Last time I saw a limited company walking down there, I think I was very drunk at the time. So that doesn't happen, but the limited company has to be able to talk and represent itself, and therefore a member or a director of the limited company would speak at partnership meetings on behalf of the limited company. If a partner dies, so I'm a limited company and you're a private person and my company's in partnership with you, the private person, and I'm sorry about this, I'm going to kill you, and you die, then the partnership's dead. There is no partnership. If there were three of us and you die, then we have a new partnership. If we want, we have a new partnership between Eddie and me limited. I don't think that has ever been asked in the exam. Raising finance is another advantage. It says it's advantages of being a company as distinct from being a partnership. And I have to subdivide companies. It is against the law for a private company to invite the public to buy shares in the private company. A private company is not allowed to do that. In fact, it says within company law, it says that a private company shall, by its constitution, by its fundamental rules of existence, it shall be prohibited from inviting the public to buy shares. I can offer shares privately. I can say, Jana, do you want to buy some shares in my private company? Madra, would you like to buy some shares? But I can't advertise it in Business Vienna. I can't say in the newspapers, invitation, I'm inviting offers to buy shares in my company. But a public company can. I can say I can sell the full company, I can issue additional shares, I can do whatever I want.
But limited company, you can advertise for sale.
It's not the company which is selling the shares. It is me, the shareholder, who is selling my shares because Sandra wants to buy my company. but it's me, the individual private person, who is selling my individual private shares to Sandra. So it's not the company which is issuing shares to Sandra. What I'm saying is that it is against the law for a company to invite people to buy shares in the company. I can invite any of you to buy my shares, but I can't as a company invite people to buy my shares. So that's a private company, but a public company can. A public company can advertise or can issue a prospectus, or it can advertise in the newspaper and say, invitations are given to any member of the public to send in an offer to buy new shares in the company. And a public company can raise finance from the public in that way. And it's not just shares, it's also loans. A public company may invite the public to lend money to the public in exchange for a piece of paper. And the piece of paper says, I owe you £100. So that is available for a public company, but it's not available for private companies. So that's one way of raising finance. There is a second way in which a company can raise finance that a partnership can't. And that is, a company, when it borrows money, it does so by issuing an IOU, but the IOU is called a debenture. I wrote the word up earlier. It's a debenture. And a debenture is the written acknowledgement of a debt. So the company writes IOU and they stamp it, and you give me £100 and I will give you a piece of paper that says I owe you £100. Would you lend money to a company unless that loan was secured, unless it was protected and safeguarded? And Solomon didn't. Solomon lent £15,000. He said, don't pay me, just give me a piece of paper for £15,000. But I want security. And in the event the company goes into liquidation, I want to have the right to take these assets, to sell them, to raise the money to pay that £15,000. This is called a secured debenture. And I don't want to get in heavy detail with this because we're going to look at debentures later, hopefully tomorrow. But the security which is offered may be either a fixed charge which attaches to a particular immovable, permanent piece of property, like a building. Or it may be a floating charge which doesn't attach to a particular identifiable piece of property. So a floating charge will float over typically a company's current assets like inventory and receivables. And during the time that the floating charge exists, the company is free to sell the inventory and raise money and buy some more inventory and sell that on credit and sell it to debtors, and debtors ultimately will pay. So these current assets are flowing through the company on a regular and hopefully frequent basis. A partnership or an individual, it is against the law for them to secure their loan by pledging, by promising their current assets as security. So partnerships cannot secure loans to the partnership by way of floating charge. They can't promise their inventory. They can't promise their receivables. They can't promise their goodwill in a partnership situation. But both public and private can. They can promise their current assets as the security for money which is lent to the company. So raising finance, we have two elements of it. First of all, inviting the public to buy shares in the company, or secondly, by borrowing money and securing that debt by way of floating charge. Ownership of property. A company will own its own property. It will possibly buy that property from the directors, but a company will own its own property. A partnership, the partners may introduce their own property into the firm, in which case it stays the property of the partners. But if the partnership as a firm buys property, although the property belongs to the firm, because the firm is not of a perpetual existence, on the death of a partner, that property has to be subdivided. That property has to be valued and maybe sold in order that you can arrive at a figure to pay to me, a retiring partner, or me, my estate, as a dead partner. So a company doesn't get that problem. When a member sells their shares, he doesn't say, well, I want 1/1,000,000th of the value of the property which the company owns. I own shares in a company. I don't own the property in the company. Whereas partners have a share of the partnership, and the partnership then will need to account to the partners for the value of the property which the firm owns. Another advantage of being a company as distinct from a partnership. What is the minimum number of members in a public company? 2. What's the minimum number of members in a private company? 1. So I, on my own, can set up a private company. And I can appoint myself as the director of that private company, and I only need one director. Historically, until the 2005 Companies Act, 2006 Companies Act, I used to have a company secretary, but that's no longer a requirement. This last 5 years, it's no longer necessary for a private company to have a company secretary, a second officer at the top of the company. So in fact now any of us can set up a private company where individually you are the only shareholder, you are the only director, but you're trading through the mechanism of a company. You might not want to. You might just want to say, I want to carry on a business in my own name. I don't want limited liability. But that's your choice. Do you want to carry on business on your own, or do you want to create a company and therefore protect yourself in terms of limitation of liability? So that's our choice. I asked you for the minimum numbers. What's the maximum number of members in a public company? There is no maximum. What about the maximum numbers of members in a private company? There is no maximum. What about a partnership? Minimum number of members in a partnership? 2 by definition. I can't be in partnership on my own. I think I'm a wonderful partner. I do. And so you have to have at least 2 people in a partnership. But there is a maximum number of members in a partnership, which is a bit strange because your instant thoughts may go to accountancy partnerships. And PricewaterhouseCoopers, by way of example, I believe have got 12,500 partners worldwide. All right, but one thing, they're not really partnerships, they're actually now created as companies. So although we call them partners, they're actually directors. And the other element is that Pricewaterhouse Partnership and other big firm partnerships is not in fact a single partnership. They are almost franchises. So in Romania there will be PricewaterhouseCoopers, and the people who are at the top of that may be answerable morally to other Pricewaterhouse partners in other parts of the world, but it's actually their own firm. It's actually their own company. So although they all carry the same name, in fact they are limited in their geographical spread. So there will be a Pricewaterhouse partnership in Poland, and smaller countries like the former Yugoslavia may be the fact that 6 separate Pricewaterhouse firms in Yugoslavia are all combined and they call themselves the Balkan Partnership, maybe, and therefore they would meet on a bit. Not only the Balkans, the Baltics might also be the same, where Pricewaterhouse Estonia, Latvia and Lithuania will be answerable to each other and they run it as a regional business. I don't know, but that would not be unusual. So there's no practical limitation for people like PricewaterhouseCoopers. But a partnership of, let me think of an example. All of us together, we decide to create a partnership to own a supermarket. We can do, that's not a problem. But we can't have more than 20 partners. 20 is the upper limit for partnerships. There are exceptions. There are exceptions. And it's not every accountancy firm that has created a limited company. So accountancy firms, audit firms, are one of the exceptions. There is no limit to the number of partners in an accountancy firm. There's no limit to the number of partners in a law firm, a firm of lawyers. But generally, partnerships which are not professional organizations will be limited to the number of 20. I'm interested in a partnership. I also have shares in a company. Christina asked a moment ago, can I transfer my interest in a partnership? And the answer is no. Can I transfer my shares in a company? No restriction. There may be, it may say within the Constitution, it may say that in the event that a member wants to sell their shares, they must first of all offer them back to the other members. And if it says that in the Constitution, then that's what I must do. I can't pass them down to my children. I have to offer them back to the remaining members of the company. And they may, according to the Constitution, they may be obliged to buy those shares from me at a fair price. A fair price will be determined by arbitration or by independent valuer. But generally, there's no limit. If I own shares in a company, I can transfer those shares in that company. So transfer of interest, it is easier to enable others to benefit by way of shareholding than by way of partnership. But there are disadvantages. There are legal implications. There's a lot more law related to company than there is related to partnerships. A lot more requirements, a lot more bureaucracy, and therefore also, by definition, a lot more expense. And publicity and disclosure. For example, within company law, there is a requirement that, for public companies, there is a requirement that there shall be precise detail shown within the financial statements, exact detail within the annual financial statements, showing how much each individual director has earned during the last accounting year. And not just salary, but benefits, pension rights, share option schemes, bonuses. This needs to be subdivided column by column, partner by partner, so that shareholders can see exactly how much that partner has earned in any particular 12 months. Partnerships? No such requirement. Partnership accounts are private. The only people who see partnership accounts are the partners and the taxman. And if they have an auditor, the auditor. But nobody else has any right to see partnership accounts. Company accounts have to be distributed, they have to be published, they have a website, they are available for inspection. Every year you have to send your accounts to the registrar, and they are public documents. And anyone can ask to see them. So for a company, there is a lot of publicity and a lot of disclosure. There is no similar requirement for a partnership. Page 64, just an expansion of these disadvantages, and particularly expansion of the legal implications. The formation has to be done according to strict rules. There are specified documents which must be completed and must be sent to the registrar, together with the expense of registration. And if you're going to pay a professional, typically an accountant, if you're going to pay a professional to register a company or create a company for you, then that's going to cost you an accountancy fee. You've also got the annual audit. And almost by definition, an annual audit is, shall I say, not cheap. Not particularly cheap. And of course it's not cheap. It's a professional service that you're buying, and you expect to pay a professional level fee. We have the expression in the UK that if you pay peanuts, you get monkeys. The cheaper your audit fee, potentially, the less competent your auditors. If you want a reputation, if you're looking to grow big, if you want to lend credibility to your financial statements, then you'll pay an auditor with a certified auditor registration certificate. If you don't, you get somebody cheap and it's not good. So audit fees are not likely to be inexpensive, they're likely to be expensive. Share issues. There's a process to be followed with the issue of shares, and there's documentation to issue and postage to incur, and I have to record this, and not only must I, when I'm issuing the shares, create a piece of paper that says this is a share certificate entitling by name the shareholders to so many different types, of so many different shares of so many different types. Not only that, but I then must keep a record of all these people. So once I start going down the road of companies and shareholders and lots of shareholders, millions of shareholders, I'm then going to have to pay somebody to look after the detail of who these shareholders are. And I need to know that because I need to know who's entitled to receive a dividend, who's entitled to receive a copy of the financial statements. So it's an added expense, it's a big expense. Meetings and resolutions. In the context of our small partnership, just the three of us, meetings are nothing, are they? I just say, can we have a meeting, 5 minutes in my office? All right, in your office. So it's nothing. There's no formality, there's no expense. It's far more informal than a company which has to have an annual general meeting and send out notice of the annual general meeting and send out copies of the resolutions and proxy forms and details of why. There's a lot of expense. And they have to call all these members together on an annual basis at higher premises in order that these people can meet and discuss about the financial statements and about the resolutions to be proposed. It's an expensive operation. We don't have that within partnerships. Liquidation. Liquidated partnership. Christina, Eddie, I've had enough. Okay, the partnership's not likely to operate at a profit ever again. Let's finish it. Okay, we'll finish it. That's it. An oral agreement to finish. Let's collect all the assets, pay off all the liabilities. Anything that's left, we'll then divide amongst ourselves or pay off our own debt according to the accounting records. And that's it. It's easy. It's straightforward. But for a company, you have to appoint especially a qualified insolvency practitioner, a QIP, a qualified insolvency practitioner. Typically an accountant, but sometimes it's a person qualified in law. And they're expensive. Whereas with a partnership, we just lock the door. Proper accounting records must be kept. For a company, it is company law that companies shall maintain proper accounting records. What sort of accounting records shall we three keep as a partnership? Well, I've got a little diary here. I made a note that 3 weeks ago I spent some. That's all you need. There is no requirement, no statutory requirement, to maintain a detailed, accurate record of cash paid and received, a detailed, accurate record of all purchases and sales, of all incomes and expenses, in such detail that a company must be able to prepare a full set of financial statements showing a true and fair view as at any point in time within the previous 6 years. No requirement for a partnership. There is a heavy expense involved in maintaining proper accounting records. For a partnership, we may, if we can get it past the taxman, it's potentially the case that we keep no records at all. We just make up our financial statements at the end of the year. We don't need an audit. Give me a figure for revenue. How much do you think? 50,000? We're going to pay a lot of tax. I'll put 30. I'll put 30 down. There's no audit. You put down what you want. Naughty, not good, dishonest, but there's no statutory requirement to maintain records. And that's all. I mean, that list of 6 points is expense, 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 expense. They all necessarily lead on to expense. And publicity, I've already mentioned details of the directors. Business details. Revenue, 4 million. Cost of sales, 500,000. What are our customers going to say if they realize that we're buying stuff to sell at a 700% margin, 700% markup? They're going to say, you're robbing, you're stealing from us. But those business details are shown within companies' financial statements. They're shown within a partnership. But nobody sees the partnership financial statements.